Now, you're obviously aware that the Reserve Bank of India has, over the course of a couple of months, increased the policy rates that essentially govern both fixed deposits and other interest instruments, as well as loans. The interest on loans, it has raised those policy rates by 90 basis points in an attempt to fight inflation. Now, let's understand over the course of this conversation what the implications are for you as a borrower. And we'll also talk about a new category of credit products that are buy now, pay later. And we'll discuss everything that you need to know if you're considering availing of this product. Pankaj Bansal, the Chief Business Officer of bankbazaar.com, is joining in. Pankaj, thank you so much for taking the time and good evening to you. Let's first understand what the implications of this 90 basis point hike are. It's very simple. Loans are going to head higher, but what is the quantum that people can expect? It would be very large for mortgage loans, right?
Yeah. So I tell you, Alex, you're right. I think there's a 90 basis points rise in the repo rates has happened. So what will happen in the entire scheme thing? I'll just give you a broad example. Assuming if a guy has a 30 lakh loan for, uh, will be paying about 23,340 odd rupees as an EMI on a 30 lakh loan size. Now, the moment it moves from 7% to 7.9%, there are two things can happen. One, his EMI will increase on a monthly basis for 20 years to about 1648 rupees broadly. And if he doesn't increase his EMI, there will be a tenure increase, and that tenure will be about 48 months he has to pay additional. So technically, if I have to say, it's 4 years more that he has to pay on a 20-year loan just for 30 lakhs loan that he has taken. And the overall interest that he has to pay over and above what he has been paying right now at a 7% rate would be about 7 lakh rupees over a period of 24 years now. So I think this is how broad level calculations have worked out. So it's 90 basis points is like, they'll have to pinch the pockets of the consumers and they'll have to shell more.
Mathematical calculation that you just spoke about, the interest cost is significantly higher when you choose to increase the tenor of the loan. It's always better to increase the EMI. But the question then is, we saw a transformation in terms of the way in which rates are calculated, right? Or the rates are pegged. There used to be an MCLR or a marginal cost of lending based formula, and I think the RBI decided that the transmission wasn't taking place fast enough, and so therefore it changed to a benchmark linked loans, which is essentially the repo, and those get reset every 3 months. But there are a lot of people, Pankaj, that are still on MCLR. So how quickly does that transmission happen? Has transmission already taken place?
So for these two types of, you're right, Alex. For these two type of categories, there is a loan agreement which clearly defines is it on MCLR or ECLR. So if it is on MCLR, obviously the guidance is about 6 to 12 months normally it takes for the rate hikes to print, and it will depend on a loan agreement to loan agreement basis. But when it is directly linked to repo, which is your ECLR, what will happen is that within 3 months the bank has to do it for the normal consumers. So the transmission happens very fast and quickly when you do a repo based external benchmark. But when it is MCLR, it normally what we've seen is about 6 to 12 months. And within the 6 to 12 months, it also varies depending on loan agreement to loan agreement. So these are the two different ways in which, the rates will move.
I was also curious because I was looking at a recent report. Kotak Institutional Equities put out a report. It quoted a lot of TransUnion CIBIL data, which pointed out this burgeoning category of buy now, pay later. For people who are not familiar with how it works, could you explain this for us? And also, is there an interest component in buy now, pay later, or is it interest free?
Yeah, so there are, it's a good this thing. So this is a category which is ballooning in the country. Obviously, after this pandemic hit us, a lot of digital transactions happen on buy now, pay later. So there are, how it operates is that it's just like an EMI that you get it on your checkout, right? So moment if I purchase, I'll just give you an example for the benefit of the consumers. If you purchase a mobile phone 20,000 rupees, there will be two options that you can pay. You can easily convert all that number into your EMIs, monthly EMIs for maybe 3 months, 6 months, 9 months, 12 months, depending on the merchant, what kind of an offer he's posting. And it could be either with the interest or it could be without an interest. If it's without an interest, somebody must be submitting it. either the merchant will be submitting it or the financer may be submitting it. So between the two, the submission will happen. But broadly, we have seen it's a merchant category submission which happens. So if it's a zero EMI, so if I have to pay 100 rupees and 10 equal requirements, every month I'll have just to pay 10 rupees, and that's the way it is. But it is structured in the price of the product. So that's a catch that consumers will have to look at it. But if it is a normal interest-based EMI, there will be an interest for 1.5-2% maybe for a quarter, or maybe 3% for a quarter, depending on what kind of EMIs that merchant offers. So it varies from merchant to merchant what kind of EMIs that person gives you. But it can be spread over a period of 3 months, 6 months, 9 months, and how you want to pay it is something that you can do. It happens both on offline when you are visiting a physical store, because that's where the checkout also happens. It also happens on an online. If you go on an online website like Amazon's or Flipkart's and any of these people, you will also see the offers of checkouts for various companies saying buy now, pay later. And you can club it into an EMI offer over a period of maybe 3, 6, 9, 12, depending on what kind of offer that checkout website provides.
Most of these are interest free, right? Because that subvention takes place from the merchant side, right? Okay, so therefore there is no implication of a rise in the interest rates in the economy on these products, right?
Correct.
Okay, but at the same time, I was looking at this same report and it suggested very interesting data points, which is the type of consumer that has been taking these loans, or not loans, but availing of these schemes. And it turns out that over 75% of people who take buy now, pay later are less than 35 years of age. Quite a few of them are actually within the ambit of the banking space, in that they have lines of credit available to them. And also, quite a few of them are actually tending towards defaulting on these payments of buy now, pay later. Is there an issue when you default on a payment of buy now, pay later? Does it count towards a decrease in your credit score, for example?
No, absolutely, Alex. Anything which is a credit product in the market, it's subject to your ratings in terms of your consumer ratings will get impacted if you don't repay it on time. So if I have 3 months repayment track, I have to repay within those 3 months. Otherwise, my credit rating will get impacted. And obviously, I'll have issue in the next loan that I want to take it. So your credit score will decline. But if you pay it properly, right on time, with no exposures from the revolver side, obviously this will be taken care as a positive impact on your credit score. So I think there are two ways to do it. One, you build a credit report around it, you pay it properly, you take a small ticket loan, and you build your credit history. That's one thing that consumers can do. Second thing is that if you've already availed that loan, my suggestion is that you should pay it on time. You should remember, because there are multiple transactions that can happen on a BNPL. I can take a 10,000 from X, I can take a 20,000 from Y, and it could be spread across 2, 3, 4,000, whatever EMI that you've planted, and you have to pay it on a regular basis. So all that a consumer should keep in mind, that if you have multiple lines also on BNPL, make sure that you pay on time, because every line that you don't pay on time will get impacted, and you will have a credit score impact as a resultant of non-payment of any of these credit lines that you have availed on the merchant or on the website.
Interesting, because this, again, I'm referring to this report. It says that 23.4% of buy now, pay later customers that also are personal loan customers have actually defaulted on a loan and not paid back for over 30 days. And so in banking parlance, you have 30 day to 60 day and 60 day to 90 day. Above 90 day, then it becomes non-performing, right? But at what stage, as soon as you miss a payment, it affects your credit score? Is that it?
Yes, the moment you miss the score, if you have to pay in 30 days X amount, if that's not paid, obviously it'll start reflecting in your credit report. And second is that this could not be directly correlated that the consumer ability to pay is affected. It could be even that he has forgotten to pay. Because if you have multiple lines and you just have a 2,000 rupees transaction, you just forget also. So this is something that I would like to tell Alex in this particular show, is that when you take these lines, be responsible in paying it as you're paying your home loans, as you're paying your personal loans, the large ticket ones. In small ticket ones, sometimes consumer just misses out the cycle. He will not even remember that this payment has to be made. I have to credit an account, or I have to fund an account where this auto debit will happen. All that consumer should make sure that once you are there, you pay it on time, even for a small payment like 2,000 rupees a month or something like that. So that the quantum is not important. It's the repayment discipline that is important. So make sure that you pay it on time. And I think That's the best thing that you can do when you're doing it. Secondly, your point on 23%, as I just started off this conversation, it could be a factor of ability, it could be a factor of customer just forgotten. So there could be multiple factors which gets clubbed in, but we'll have to see in the longer in terms of the portfolio behaves over a, I would say 190 to 180 days scenario over a long run.
Does the other data points, Pankaj, that TransUnion Sibyl has released seem to suggest that that is in fact the case? Because like I said, 75% or thereabouts of people who avail of buy now, pay later are near prime or above prime. That is, and prime essentially, subprime is when you're not creditworthy. Close to prime essentially means that you are creditworthy. So it seems to be forgetfulness more than anything else. But just to drive home the point, I think, how much of an impact can you see if you were to say, for example, have a missed payment on a buy now, pay later scheme, or in fact miss a payment on your credit card, you see an impact on your credit score as a result, and then you have to go and take a mortgage loan. What kind of impact can you see on the rate that you can then claim?
So it's like, Alex, what happens is that once you miss a payment, obviously it starts reflecting on DPD reports, DPD, and once it starts reflecting on DPD reports, obviously your rate of interest for a home loan, because the score will go down. The percentage points can vary from depending on what kind of other exposures, credit lines you have. So there's a multiple factors that built into a credit score. So this could be one particular factor. There could be a weight attached to this factor. With this weight, you will have some understanding of maybe 10 basis points, 20 basis, depending on what kind of weights that has got attached to the factor. So it's very complicated in that sense. But broadly, this is guaranteed your credit score will go down. The moment your credit score will go down, when you take a home loan, your interest rate, if you're getting 7.8 in a normal market, will be maybe higher, maybe 10 basis points, 20 basis points, depending on the slab that the NBFC or the banks have put in for that particular credit score. So that will happen. But obviously, you're not defaulted on it. So obviously, you will not be denied a home loan. But the moment you default on a couple of payments and then finally it comes into your NPA kind of a stuff, obviously the things becomes a little messier. But broadly on a score level, your interest will be directly proportionate to your score. The higher the score, the lesser the interest. It's a very simple home loan mathematics right now. Second, from the chances of approval also, if your score is higher, your approvals will be higher. It's a very simple, and across the retail asset product. It's not limited to home loan. It would be even for personal loan, or you want to take a credit card after you take a BNPL line. So all that will get impacted. So that is something that there is no right answer to the next basis points will fall, but it is a summation of 10 different things, I would say. And then finally one score will come out. So that's how you have to take it.
So Pankaj, just to wrap things up and to conclude, the first thing, of course, is that home loan interest rates are going up, or rather loans interest rates are going up. You're better off increasing your EMI because your interest cost would be lower. When it comes to BNPL, it's a great product, but do remember to pay on time, because otherwise you can have implications for your credit score and therefore any loans that you take in the future. Thank you so much for taking the time. Pleasure speaking with you.
Thank you.